It's Friday, April 30th. This is Street Live. I'm Catherine Ross, and I am joined, as always, by Jim Cramer. Jim, there's a lot of negativity in the markets for a Friday, so what are you watching?
Well, I'm actually trying to see where the negativity will be busted. I mean, obviously, Amazon up 69 when it was up only 25 on Squawk on the Street. I said, this has gotten ridiculous. I mean, when you report a quarter that is that great and only get up 25 points, that's just the market being wrong. I'm watching stocks like Microsoft trying to make a stand, been down every single day. AMD trying to make a stand. We have a lot of companies that are in the highest growth model: Okta, RingCentral, Zscaler, CrowdStrike, Coupa Software, ServiceNow. They are all up. So I know it's early, but I think the Nasdaq is trying to make a stand here after multiple days where the only things that were up were the one stock that day that reported a good quarter.
Let's talk about meme stocks. You did tweet that meme stock Microvision is showing its true stripes after a less than stellar earnings report from this company. What's your advice here, Jim?
Well, it's just, it's just a little cap stock that they've made into something. It was a $90 million stock. They made into 3.7 billion stock by battling the shorts on it. I thought they kind of indicated there was some really impressive LiDAR. They didn't have it. The quarter was miserable. I challenge the people from WSB or whatever it is, the Wall Street Bets, where they say that there's 10 million degenerates. I challenge them right now. I challenge them to find another stock besides GME or AMC that has a big short position that they can make money on. The way to make money is to find good companies. They've decided that the way to make money is to bust shorts. But what have they done after GME and AMC? I mean, are they two-trick ponies? Is that all they are? So I think that the Wall Street Bets people, particularly the ones who love to run my old video of me and Aaron Task, which where it said after, listen, I didn't do these things. I'm just trying to explain what it goes on. Or they want to focus on Bear Stearns. Most of them spell Bear Stearns wrong, not recognizing that I told people to short Bear Stearns the weekend before it went under. This is what they focus on rather than deal with the substance, which is to try to find other stocks that they can make money in. I mean, they like to dredge up things from a previous generation, which is fine. You can do that, but at least I have a track record. What do they have? So let's come up, Wall Street Bets, with something, not Microvision and not some other junk like a stupid little cannabis stock, but something that requires some actual thought. Maybe they look at a company like a UPS or that we had for Action Alerts, or an Amazon. Maybe they question whether we're right in Ford or a Boeing. But this endless fixation on junk stocks like Microvision or like Palantir for day because Kathy Wood likes it. Not that they would ever be in the same room as Kathy Wood, or they still with the GameStop because of Ryan Cohen and his masterful plan, or AMC, where my friend Adam Aaron may be doing something. I don't know. I mean, they have to step up. They've become very tiresome. I used to go to the site to learn some things. I stopped going because unless you come up with a new idea, Catherine, don't bother me. Not now, not ever.
What about Coinbase as a pick for them? I mean, it is one of the top 10 holdings in Kathy Wood and ARK Invest Next Gen Internet ETF.
That'd be great if they understood that it's a wallet. That would be terrific. Dow not doing well today, the Nasdaq triumph. But yeah, if they understood Coinbase as being something other than, say, like a satellite company, that could be very good. I'm looking into a company called Orbital. I wonder if they could help me on that. But I do think that they're tiresome. They could very easily throw darts. Oh, Jim, you could throw darts, and what would you hit? Well, how about FANG, which I created and reiterated endlessly ahead of the quarter. So I'm a little rambunctious and fractious, is a good horse term ahead of the Derby, about the people at Wall Street Bets because they've become predictable, attack me, which I don't read anymore, so they can continue to attack me and waste their time, but not pick good stocks. Whereas we picked Crown Castle, and it was pretty good. We picked just during this earnings season. What did we have? We had Amazon, we had Apple, we had Facebook. We had they're doing pretty well. Alphabet, that's a good one. So I mean, I just think unless they give us something, they're going to lose whatever relevancy they may have had, and the 10 million degenerates are going to go to a site that I create. I think I'm working with Ben Stoto. I think we're going to create a site, and it's the site that people are going to go to. and it's going to have new ideas. It's going to be fresh, and it's going to blow them away. I have to talk with Ben about it, but it's going to be different. We will lure the 10 million degenerates because, unlike them, we were going to have something else other than AMC, Microvision, and Sundial, marijuana, and GME. I mean, and maybe we even talk to Ryan Cohen, see what he's really going to do, which is a lot more than they're doing, believe me.
Jim, let's talk about your real money column from this morning, because you took on the taxing. Yeah, because it's interesting, Jim. You took on this myth that raising taxes on the rich will hurt stocks, and you broke it down in a very digestible way. So I want you to break it down for our viewers here who haven't been able to read your real money column yet.
Yeah, well, I mean, what is capital gains, unless you know that the rate's going to go higher next year instead of being retroactive? It's an incentive to own stocks, not to sell them. Why would you sell it? I mean, if you knew that, I mean, just ride it through, for heaven's sake. But people are looking for investments that can make money. All right. Well, munis can't make money. You can't make money for the most part. Corporates are ridiculous. Gold, no. Crypto, maybe it's stalled, and it's certainly not really meant for a lot of investment. But stocks work. Remember, when you buy a stock, you're betting on a company, not on the taxman. Yes, if they change the corporate tax, we might have to think about it. But what an opportunity to buy stocks, particularly stocks that have good dividends, because the dividends are still going to be this great tax break. Anyway, people don't own stocks to flip them anymore. That's a different era. The people who own stocks, they own them in ETFs and they own them in index funds. And so it's not as nearly as relevant. I urge people to open an account, read the real money piece. I think you'll find it's kind of entertaining but logical about why the president has not hurt the stock market.
Yeah, I mean, your suggestion in the final paragraph, and I'm quoting you directly here, Jim, is stop trying to relate taxes to stock behavior.
Yeah,
so
I mean,
with that,
I just find, Catherine, that people want to draw conclusions when there's no conclusions to draw. And that's a game. I used to play it when I was in my 20s. I would say, well, it's, geez, I cover a homicide here and a homicide there. There must be a lot of homicides being committed. I mean, that's when I was a homicide reporter. But I do think that what matters is not taxes. It's the performance of companies.
I agree with you. So let's dig into some earnings reports, Jim. And I want to start off with Twitter, because Twitter was under pressure after missing on users and their low guidance, but they did beat on earnings and revenue. So were you disappointed by this earnings report? And should investors worry about?
I am, because of Facebook and Google. I mean, their numbers at Twitter were suboptimal versus Facebook and Google. Facebook and Google looks like they're much more effective ways to get consumer products sold. Now, Twitter is saying, look, the consumer product season got started late because of the Capitol, COVID, but it didn't get started late at Facebook and Google. They had fantastic numbers. So I question, at a certain point, Twitter is a buy. But I think people are going to say, you know what? It's going to be back to that takeover stuff, and it's 45 billion right now. So it's hard to be taken over. But it is going to be talked about as a takeover story if you don't get the stock up.
I've got two questions for you following that. First of all, it is down over 12% today. So do you think that it could be a buy today if you really believe in the long-term story of it? And my second question is also based on the fact that you brought up Facebook and Google. And I've asked you a similar question here, where Facebook and Google, they could be impacted by the reopening. And I'm wondering if Twitter could be as well, as people spend less time at home and on their screens.
Well, I think that the reaction here is that they must not have been. There's some companies, some consumer products companies that are trying to figure out where to put their dollars. And it looks like it's not going to Twitter, because Twitter does not have the growth that Facebook and Google have. And it's just, that's just to reopen or not. Twitter their growth is probably below some of the others. So I'm not, I just think you keep buying Facebook, keep buying Alphabet, just keep buying.
So, Jim, your stop trading this morning was Chubb, because you expect a good quarter. And I'm wondering why should investors eye an insurance stock, and is Chubb the one to go with?
Reported a good quarter. Okay, so I'm not eyeing good quarter. They reported a good quarter. What matters is that Chubb's raising rates. And we saw that also with Hartford. If you use Chubb, as I do, then you know that Chubb has been raising rates. This is small, medium-sized businesses. They can get away with it. I mean, the industry itself, for workers' comp, for fire, for just insurance of anything that you think is going to happen, kind of pandemic-like, business interruption insurance, these are all up, and they're expensive as all get out. And as someone who's a restaurateur, I see what bills have gone up more than any others, other than labor, and it's insurance.
So you think that it's a must-have for your portfolio at this time right now?
I like Chubb very much. I think that Evan Greenberg is a champion. The stock has done incredibly well. It's just that insurance is boring, and a lot of the people like the meme, like the Wall Street thing, they would never do a Chubb. Why? Because it's hard to understand, and it doesn't have big short position. I think they would think it's a fish.
Two stocks that we always hit on every earnings season are Chevron and EXXON. Now, Chevron posted better than expected revenue, while ExxonMobil topped their earnings forecast. However, you don't think that these two names are really driving this market in a way that they once might have. So what did you make of these two earnings reports?
Well, they're not owned as much by the people used to. Exxon's at 6% yield and Chevron's at 5%. Chevron's a better buy. Why? Because Chevron's got more growth characteristics. Exxon's been cutting back. Darren Woods told a pretty good story about carbon. But what the reality is that Chevron is the more consistent of the two. In the old days, it was Exxon. Now it's Chevron. And I think Chevron's worth buying. I like Chevron and I like Pioneer. And then the rest of the oil complex sold to you.
So there's a question that came to my mind a couple of days ago, Jim, based on your dividend segment on Mad Money earlier this week. But last night you also brought up the importance of a diversified portfolio. So I want to bring this in now. Why should investors have a stock with a dividend in their portfolio? Why is it in their best interest?
Well, I mean, I think that dividends, first of all, are taxed better. You can get to keep more of the income than you can with, right now, with capital gains. I also think that I like the steadiness of them and what they give you in terms of a trampoline. Both oil companies, Exxon and Chevron, have good dividends, but these are good examples of, like, can Exxon still cover the dividend? Well, arguably with oil at 60, maybe. Yeah, probably they can do it. Chevron, yes, they can do it. But if oil goes to 40 again, which it could do, I mean, the curve for oil out 5 years shows oil in the low 50s, 54, and that's not enough to be able to continue to pay those big dividends. So we have to be very careful. I just don't think there's stocks worth owning except for Chevron.
Okay, so I want to end the show with Amazon, because Amazon, following in the steps of Apple and Facebook, really smashed expectations on their earnings Thursday night. And by blowout, I mean that no Wall Street analyst came close to predicting this $15.79 EPS that the company reported. So, Jim, how can Amazon keep up this momentum?
Well, look, Amazon just keeps surprising, but they have a very long letter that explains about all the things that are going right and the seeds that they are planting. They are wiping the floor with everybody else, Catherine, including Walmart, which we own. I mean, if I'm Walmart, I'm trembling at the end of this thing because they're just putting up so many flags. They're just winning in so many categories that whether it be the Whole Foods, whether Amazon Web Services, advertising now really, really big. Data search is just really big. It's extraordinary. It's extraordinary. And I think that you got to own the stock.
On actionalertsplus.com on our daily rundown show, which we are heading to right now. Otherwise, guys, we'll see you next week. I'm Catherine Ross, and thank you for joining us.